So two really good points to bring up. First is the idea of, is the point of validity the same thing as a stop loss? You know, yes and no. The point of validity is simply that area on the chart that I determine that my trade should no longer be valid. Now sometimes I can afford that distance. In other words, the risk-to-reward ratio, what I'm willing to risk on a certain trade for any number of factors. It could be account size, it could be the weekend's coming, it could be an economic report's going to be released, or London's getting ready to close. Whatever that determining factor may be, my willingness to hold the trade to a certain level, meaning the point of validity, might be affected by a number of things. For the most part, it will usually be affected by the risk-reward ratio. In other words, I don't ever want to risk more than I could potentially see as a target, as what we would typically call a profit target. So the point of validity is simply that spot on the chart where there is just no arguing with the trade's validity any longer. I think most people get into trades, but they don't think about why the trade is no longer valid. And I think, by the way, this is the psychological trap that most traders fall into when they don't follow their stop loss orders. Because usually the stop loss orders are these random dollar-driven, I'll get out here because I don't want to risk any more type decisions. And then we wonder why we have a difficult time adhering to them, because there's very little logic behind them. For me, my experience has been, if I understand why something is no longer valid, I'm not arguing with the dollar amount. I'm not saying, oh, I risked $150 or 150 pips, whatever it may be. What's 160? That's easy to talk yourself. It's very easy to talk yourself up there. But if you have a point on your chart that says, at this level, this is no longer valid, that's when I find I have an easier time adhering to my risk management. So the point of validity is not necessarily going to be my stop loss. I might determine that I don't want to risk that much, and I might use the middle line of the wave, or I might use another level in between. But that's what I call cheating in my stop. I acknowledge that the point of validity might be further away, but for my risk-reward expectations, I might go ahead and find a separate resistance level for this short where I could park my stop loss just above it. Okay? So it's still going to be determined by support and resistance. In this case, I'm looking at resistance. Support will be my downside targets. Resistance will be my risk. So I might find an alternative risk level in order to go ahead and protect myself from further loss. So there's a little bit of flexibility there, but like I said, nothing should really exceed that point of validity, because that's where I expect the sentiment to shift and possibly accelerate. How do we know the difference between a reversal and a correction? That was another great point. And the point of validity is also applicable here, because if I feel the wave is at hand keeping prices down, and that's my belief, okay, if I think the 3,600 level is that level that's going to create a ceiling and not allow prices to move up much higher than that, then my idea of where prices will reverse versus correct, it's two different mentalities, isn't it? The point of validity basically is that point at which, if I'm expecting prices to accelerate higher from there, that is absolutely a level that I'm going to be thinking is now a correction. For me, the way I measure it is, as long as prices are heading downward in this 4 to 6 o'clock angle, and they stay below the 34-period exponential moving average high, which is this green line, as long as they stay below that, and we're in a downtrend, okay, let me clean this chart up a little bit. Okay, as long as prices stay below that level, those are all corrections. So again, as long as the market is moving downward and prices stay below the 34-period exponential moving average on the high, which is that green line, I will determine that those are all just corrections up until that point. They get above the 34-period exponential moving average on the high, now we're talking reversal territory. Okay? So that's the idea behind the point of validity. That's the idea behind where a swing trade would no longer be valid. By the way, if this was an uptrending chart, and let's just take a look at the Swissy, because we might have an uptrend on this same time frame on the Swissy. Let's take a peek here. Nah, not quite. Let's see. It's not as nice as that downtrend on the Euro US dollar. That's a shame. But by the way, let me just say, if this was an uptrend, okay, let's go back over to that Euro US dollar. If this was an uptrend, at that point what I'd be looking for is support from the bottom line of the wave. So the whole thing just gets turned around. Okay? So I really want you guys to understand where the trade is no longer valid, because I'll tell you, I think most people are pretty comfortable taking profits. I usually you don't have to twist somebody's arm to take a profit usually. If anything, people tend to do it a little prematurely, but profits usually are one of those things that, sure, we'd like to have a plan, a blueprint for it, but I find that where most traders get into trouble is they give a trade way too much latitude without understanding that that entry may no longer be valid in the first place. Okay? And again, notice I didn't talk dollars, percentages, pips, nothing. I talked support and resistance. The same thing that got us into the trade is going to get us out of the trade. Speaking of out, there's two kinds of outs, aren't there? There's certainly the kind of out where we're looking at stop loss. That's what we've been talking about this whole time. But what about the kind of out that we like? The kind of exit that we like? What about profit targets? Okay? What about profit targets? Let's go ahead and discuss that.